Hello everyone, welcome to today's episode of 65 Popular Science. My name is Maylin.
My name is Alan. Today we are going to talk about 2008 financial crisis.
By the end of this video, you will have gained a general understanding of the causes and effects of the 2008 financial crisis.
After the burst of dot-com bubble, US government decreased the interest rate to 1% as the way to boost the economy. Under the incentive of the lower interest rate, many people began taking out the mortgages to purchase houses.
As banks prefer a high cash flow and high liquidity, they put these mortgage contracts into asset-based securities, also known as ABS, then sold them to other financial firms such as pension funds and private equity firms.
Briefly, ABS is a security whose value is derived from value of the underlying assets. Such as mortgages, selling the ABS allow banks to transfer the default risk to other firms.
The financial firms that purchase these ABS also prefer to have a high cash flow, so they turned these securities into CDOs and asked credit rating agencies to rate these CDOs for reselling to other firms. This initiated a chain reaction as many other financial firms all began purchasing these CDOs, then reselling them to transfer risks.
CDO is similar to ABS in function, except that it is based on ABS instead of assets themselves.
As the economy grew, market increased rapidly, plus there weren't enough policies around credit lending. Many people began to believe that they were rich enough to afford their liabilities.
Under the huge profit potential with ABS trading, banks start to lowering the lending standard to include people with bad credit ratings. At the same time, many elite investors realized the underlying risk with the ABS, as the many low-quality securities entered the pool.
To manage risk, some ABS holders purchase insurance to protect them against ABS default. The rating of these insurance companies then replaced the bad ratings of the securities, making them more attractive while less hiding their underlying risks.
Some financial actors in Wall Street who did not hold any ABS also joined the gamble. They also purchased the insurance against ABS default, betting on the homeowner defaulting on their mortgages. Thus, in case ABS default, insurance company need to cover the loss for everyone who purchased the insurance, including those who did not hold any ABS.
The effect of financial crisis took place when the central bank increased the interest rate from 1% to 4%. This increased interest rate resulted in many people not able to pay for their interest, thus declared bankruptcy. The banks then took their assets and reintroduced them into the market.
The huge supply of assets in the market, primarily houses, drove the price down. More people stopped paying for their mortgages as the market price of the houses was lower than their mortgages.
With the defaults on assets, many investors were unable to realize a positive return on their ABS and CDOs. Even those who purchased insurance could not get their losses covered, as insurance companies did not reserve enough cash for this housing bubble crash.
Owners of houses could not sell their property. Unemployment rate soared. About 600 million people lost their houses. On September 15, Lehman Brothers declared the bankruptcy and has died over $619 billion, becoming the largest bankruptcy in history.
Lehman Brothers was the most influential global financial service firm. Lehman Brothers' bankruptcy propelled America's crisis to the rest of the world. To prevent similar crises from occurring again in the future, Basel Accords was implemented to ensure that banks always hold enough cash reserve to meet their financial obligations in times of financial and economic crisis. The 2008 financial crisis exemplified the consequence of underestimating the risk on default and the risk of deregulation within the financial industry. Moving forward, investors must understand the underlying risks of their investment and make conscious and logical decisions in order to benefit from their investment.
This concludes today's episode of 65 Popular Science.
We hope you learned something new. If you enjoyed it, subscribe to our channel for future content.